Welcome into AMCAP Home Loans, the William Branch Group Studios. I'm joined today by Sean Lane of FRS Credit. Sean, how are you, buddy?
I'm doing great. I appreciate you having me on as a guest today.
It's our pleasure to have you here with us in the studio. Today, we are going to talk about what many of you who have bought a house, bought a car, done anything as an adult, would likely consider to be the most challenging component of adulting, and that would be the credit score. Dun, dun, dun.
I would tend to agree. You know, I like to call our credit score, it's our adult GPA.
That's exactly what it is.
It's our grade point average. You know, everything we do has a credit component.
Absolutely. And I tell people all the time, like when I was young, you know, when you're young and you don't get it, you think like 6 figures is the target. Right. You're like, man, if I could just make 6 figures. My dad used to always tell me, son, you'll just be a richer version of poor. And I didn't quite track that until I was an adult. But now as an adult, I just think like, man, if I could only have an 800 credit score,
yeah,
I'd really be doing it.
Absolutely.
But from the lens of the mortgage side, the credit score is a component that generates many things. It can dictate terms. It can dictate types of programs. It can dictate rates. It can dictate so many things that it's so important to understand what is the makeup of a credit score. I never, financial literacy is a class that needs to be taught much better than it is now in our high schools and in our grade schools and just to kids in general. And so I never understood what is the components of a credit score. How does it work? What makes it bad? What makes it good? Just pay your bills on time. Everything will be okay. But the reality is there's so much more that goes into it than that. So today, Sean is an expert and he has joined us to talk us through that. So I'll kick it off with the first question. I mean, in big terms, big grand view, what is the credit score? What are the components and how does it work?
Yeah, so our credit score, and I like to say, especially when it comes to mortgage, our credit score doesn't get us approved. It gets us declined. You have to have the minimum credit score to even be considered for all of the other things like your terms and your interest rate and all of that. And so, many times that credit isn't up to snuff and you can't qualify. And so there's a lot of factors that go into how that credit score is calculated. And yes, paying your bills on time, that's probably the minimum thing that you want to do. Sure. Because payment history or presence or lack of derogatory reporting is the biggest component of our credit score. That's worth 35%, over a third of our score.
So lack of derogatory reporting, meaning no bad payment history.
No bad stuff, whether it's a late payment, a collection account, a charge off, bankruptcy, anything bad is going to drag you down.
Okay, so you say charge off, and that's an interesting topic for me because I've been in small business before, and I had a small business bank account that was with a very small business bank, and there wasn't the track you like a Chase Bank's going to track you down, right? But like John Doe Credit Union in the middle of nowhere is not. They don't have the ability to track you down, and it was literally like $75 in a small business account that I had no idea had been charged off. And so what are some like the charge-offs, for instance, that is the same. It's a derogatory remark. It's the same as what, not paying your credit card bill? Or I mean, what are all derogatory marks created equal?
I would say generally yes. In credit reporting and scoring, recency means everything. So something recent that happens, whether it's a late payment, a 30-day late on a credit card, or whether it's, a collection account that hits your credit report, those items, carry the most weight, I would say. A charge-off is actually going to carry a little bit less weight, and I'll tell you why. Because when something gets charged off, there's a reason that happened. Typically what happens is when you're looking at a credit card is you go 30 days late and you take a hit on your score. Then you go 60 days late, you take a bigger hit, all the way until either 120 or 180 days late, and then they charge that off as bad debt. Doesn't mean you don't owe it. It's an accounting term. Right. They basically write that off as bad debt. The credit damage based on that account actually stops accruing once it's charged off. Still very bad, but now over time, that's like a stake in the sand, and it's going to start having a little less impact to your credit score.
As time goes on.
Now, related to a bank account, bank accounts, like what you're talking about, a deficiency on a bank deposit, that's just going to hit you as a charge off, just like a collection would.
Okay.
There's going to be no late payment history associated with that.
Right. Okay. Well, and that's good to know because again, these credit scores are very challenging to understand. And I'll just tell my story briefly. I was a very foolish young man that made very foolish life decisions, and I got a credit card in the mail in college, and I'll never forget. I maxed the joker out in like 3 or 4 days, right? Like $1,500 in free money. I didn't know how it worked, and it haunted me for years and years and years because I got myself in a bad situation. I'm now 35 and have worked my way all the way back up through lots of hard work. But as I was working through that, and this little $75 charge-off thing on my credit score, when I went to handle all of this stuff, I was then told not to pay because I was just going to pay the $75.
Yeah.
Like it's $75. No, don't do that. So talk us through that. What does it look like when you find out? Okay, now I know my credit score is bad, and I'm trying to buy a house, or I'm trying to buy a car, or I'm trying to do whatever. Because like you said, we got to have credit for everything.
Right.
I know my score's bad. Now what do I do?
Well, so the very first thing you should do is take a look at your credit. Okay, and I'm assuming maybe you already have a credit report at this
Absolutely.
point, because so many people today don't have any idea what's going on with their credit. And just because you had good credit doesn't mean you still have good credit, especially in today's world with identity theft and data breaches and how things, with medical insurance and how they don't get paid quickly by the insurance company. So many things end up in collections and on your credit report. If you're monitoring your credit and keeping an eye on it, and there's lots of good companies out there that offer credit monitoring services, either free or paid, you need to know what's on the report so that you can begin addressing those items. So that's the first thing is take a look at your credit report.
Well, and the information, having the knowledge is so pertinent because there were things on my credit score or credit report I didn't even know about.
Right.
Like, for instance, a $75 charge
Right.
off from however long ago. But then you got the big boys, right? Like then you got like the repossessions and the bankruptcies. And so one thing you said to me on the phone, you said the one thing that always makes a credit score better is time.
Time.
And so what is that component of time? What is there a magic number where you wake up on this day and all of a sudden poof the magic credit score dragon's gone?
Well, we probably need to take a little bit deeper dive into
Okay.
how those scores are calculated because, like I said, the biggest portion of your credit score is how you pay your bills, right?
Okay.
It's your payment history. But then the next biggest impact to your score, which we have a lot of control over as a consumer, are the debt that we carry. And so 30% of our credit score has to do with our debt load. And revolving debt or credit cards pay a very large piece of that category. And so, you can take on a lot of installment debt, car loans and mortgages and that type of thing, and you're not going to see a lot of movement up or down in your credit score. But credit cards really show the credit scoring model responsibility. If you have credit cards and you have high balances on those credit cards, it's going to really impact your credit score. If you have credit scores or have credit cards and have low balances, it's going to show responsibility that you're not living off of your credit cards. And so, having credit cards with low utilization, a low usage of the credit limit, is very powerful for your score.
And so, just to understand that more, that is represented as a percentage, right? And it's across your revolving debt as a whole. Meaning, if you have just for round numbers, you have 5 credit cards, $10,000 limit apiece, and you've got $50,000. If one of them's maxed out at 10, you're still only at 20% of your total usage. Is that correct?
That is correct. Now, the scoring models like FICO, look at that in both manners. They look at your utilization as a whole between all credit cards, as well as individually by card. So the best place to be is below 10% utilization on all of your cards across the board.
And so that's as a rule. That's a hard and fast rule. Stay
It
below
is.
10%, pay your credit cards off on a monthly basis, and rock and roll.
That's right. And when this is why we want several credit cards on our credit file, and we want as high a credit limit as we can get so that we can use those cards and pay them in full without it really impacting that utilization percentage.
That's so. Your recommendation then is have many credit cards
I always say at least 3 credit cards is where you want to get to. Okay.
with and so that you brought up another good point there. You talk about getting higher limits, and so you can request a limit increase in certain intervals and certain. What is your recommendation for that? What is that interval? How often, if I am a responsible credit card consumer, how often should I then be logging into my account and hitting request credit increase?
Well, I generally say, as a rule of thumb, you want to do it every 6 months, especially if the lender doesn't pull your credit with a hard inquiry. So that's the other piece of this, is that Capital One and a lot of these lenders will allow you to ask for a credit limit increase every 6 months with no impact to your credit score. But if you're looking at, say, a Bank of America, they're going to pull your credit each time. And so you don't want to ask for that limit increase unless, number one, you feel like you really need it and you feel like that your credit report is in a spot where you're going to get that.
Yeah, because that's always a big question, right? Like hard pull, soft pull, ding, not ding. What? So talk to us about that, because I think that's something that a lot of people don't understand. What is the difference between the soft credit pull, the hard pull, and how do you make sure that those don't impact your credit? Because like we just bought a new house,
Right.
In the process of buying a new house, there are lots of things that you go through. You go to Nebraska Furniture Mart and they give you 0% interest for 24 months. Well, it's foolish not to utilize free money for those 24 months. And then every turn, every opportunity, there's 0 interest, there's this, but it's all going to pull my credit.
Right.
So how does that work?
Well, so I like to treat the credit inquiry as something that you do very sparingly when it's a hard credit pull. So there's 2 types of inquiries. There's the soft inquiry, which is when you look at your own credit, whether that's on Credit Karma or some other credit monitoring service, or if you go to the credit bureau websites themselves and you order a copy of your credit report, that is a soft credit pull. It does not impact your credit score. A lot of the companies you do business with, your creditors on your credit report, they're pulling your credit every month, looking at how you're doing. And those are all soft pulls, so they don't hurt you. You get these pre-authorization, things in the mail that say, congratulations, you're pre-approved.
Offer for
you're pre-approved. You're not approved, right? And so they're buying credit bureau data, and those are all soft credit inquiries, so they don't impact you. Anytime you apply for credit, it pretty much hurts you unless it's one of those offers that says check to see if you're approved with no impact to your credit score. So you want to treat those inquiries very carefully. You don't want to incur a lot of those. Now, it's the lowest category in your credit score. Those hard inquiries only hurt you by 10%, but that could be 5 points, could be 10 points, depending on your individual credit file. It could impact you. And if you're on the bubble of applying for something like a mortgage, those 5 points matter.
They do.
Yeah.
Every point matters. And that you've brought up credit reporting and credit monitoring multiple times. And how many times have we heard, well, I got on Credit Karma, my score was a 720.
Right.
And I went to the Ford dealership and my FICO score was a 618.
Right.
So why the disparity?
So there's competition in credit scoring. And then there's also new versions that come out. So everybody's heard the term FICO. FICO pretty much owns the credit scoring market. 95% of all lending transactions are using a FICO score. Then you have the other model, which is the Vantage credit score. Vantage is used by a lot of credit monitoring companies. It's used by Credit Karma. And the Vantage score is different. It's a competing scoring model with FICO. But people always ask me, well, what's my real score? They're all real scores. They're just calculated a little bit differently. Even when you look at FICO, so if you're focusing on your FICO score from a lending perspective, your FICO score is going to be different depending on if you apply for a mortgage. They're using a very old model of FICO. It's a 30-year-old scoring model. Whereas if you apply for a car loan, they're going to use a newer version, and it's an industry-specific version. So it's an auto score version that puts a little bit more weight on your automotive history. And so, anytime you pull your credit, it's going to be a little bit different. But the good news is even though those scores are different, if we understand how credit scores are calculated, the five major things that impact your credit score, we have the power to work to improve our credit. And those are 35% is your payment history, what we already talked about. 30% is your debt or your revolving debt. 15% is the age of your credit file. 10% is the mix of credit that you carry, and then the final 10% are those inquiries.
Run me through that one more time.
Okay. So we all know, we've talked about the 35% of your score is based on how you pay your bills.
Okay, so let's break that down. 35% of that is based on how you pay your bills, meaning, do you pay on time?
That's correct.
Okay, so that's 35% of your score.
That's right.
The second criteria.
Well, and the other thing that's important to note in that, if you don't mind me saying
Sure.
it, is you have to be 30 days late for them to report you late. So
Important to know.
yeah, because if you're late a couple of days, you may pay a late fee, but the Fair Credit Reporting Act says that they cannot report you late until you're 30 days late. So that's a lot of time. It really is a lot of time, to make sure that we're not reported late. So we should protect our credit from a payment history standpoint as much as we can.
Well, because look, things happen.
Yes.
Look, things happen. You forget. It's an accident. It's a tough month.
That's right.
You have 30 days.
You have 30 days from the due date before you're reported late. And unfortunately, that carries so much weight. I've seen a single 30-day late payment drop a credit score 100 points. So it's
Whoa.
very significant. Moving on into that debt load, that revolving debt,
Okay.
that's worth 30% of your score. And so, the best place to be, you hear the myth, right? The myth is you want to keep your credit card balances at 30%.
That's what I've always heard.
That is a myth. 30% is a good target. 20% is better.
And 10%
10% even better. More or less, this is not a hard and fast rule because everybody's credit report is different, but for every 10% you're utilized on your credit cards, it's costing you more or less 10 credit score points. So if you're if you're got a $10,000 credit card in total, maybe between 3 credit cards, you have $10,000 in credit limits, and you're carrying a $5,000 balance, it's costing you about 50 points.
Wow.
So for every 10% you can get those balances down, it's really going to help your credit score.
Wow. Okay, so that's 30%. So we've accounted for 65%, and that's a big chunk.
Big chunk. Yeah.
So do you pay your bills on time, and how much do you use your credit card?
That's right.
Okay. Number 3.
Number 3 is the age of your credit file. So not a lot the young person can do about that. But the age category is 15% of your credit score, and it's calculated in 2 ways. It's your oldest account on your credit report. So how old is your credit file? And then the second way is the average age of your credit file. So this is where you get into, if you open too many accounts too fast, it's going to impact
because your average is
going to go down. Okay. Then the next 10% is your mix of credit. So what kind of accounts do you have? You want to show FICO or this credit scoring model that you're responsible with multiple types of credit accounts. It's very easy for somebody to manage one account or 2 accounts. A lot of people have an auto loan. A lot of people have a student loan. Maybe they have 1 credit card. But when you have 2 or 3 credit cards, it's going to help your score because it's going to improve your mix of credit. I believe that the minimum mix of credit should be at least 1 installment loan and at least 3 credit cards. That's what you want to shoot to if you're a young person or you're rebuilding your credit. You kind of want to get to the 1 installment loan and at least 3 credit cards.
And so that brings me to a good point. I have bad credit. I can't get an installment loan. So mom or dad or somebody, wife, co-signs with me on a car. Does that help me?
Sure. Yeah, definitely going to help you. Although I believe that you should never, ever, ever co-sign for somebody.
That's every credit guy's position.
Pretty much.
Yeah,
now,
because there's so much risk.
We've all done it for our
Sure.
kids. I've done it for my kids when they're starting out in life. But I also knew that number 1, I was going to keep an eye on it to make sure it got paid, and number 2, I was prepared to step in and make the payment. But I hear this all the time. Oh, because I look at thousands of credit reports a year, and I hear, well, I co-signed for my brother, and he didn't make the payment. And, basically you're taking your good credit and you're putting it in the hands of somebody else. You're basically telling the bank who declined them, I'm smarter than you. They're going to pay me, right? And we all know how that goes.
That's so good.
Yeah.
That's so accurate. The bank said no for a reason.
That's right.
The bank said no for a reason.
Yeah.
Okay, so then that leaves us with the last and final thing.
Which are those hard inquiries.
And that represents 10%.
Yeah, that category is actually called new credit, but it's really about those hard inquiries as you apply for credit.
10%.
10%.
And so you're saying that not a huge impact, but you don't want to.
Yeah, and
go out there
every
and-
point matters.
Sure.
As we talked about, and the other thing is
Just ask the Chiefs, right?
that's right. Yeah, what a game! What a game! That was incredible.
Sorry, a little football reference there for those of you that are watching. But no, every point does matter because you're borrowing money. It's
Right.
I mean,
Yeah, I mean it could
affect your interest rate a point.
That couple of points could put you into that next tier of 740, maybe that gives you the better rate.
Yep.
That
Could
one
drop you down to the tier where you now need PMI. I mean,
absolutely,
whatever.
or maybe drops you out of even being able to qualify.
That's
Right?
right.
It might get you down to a 619, and now you don't have the 620 that maybe the lender's looking for
That's
for
right.
that loan product that you need.
And as you grow and your credit file ages and gets better and all of that, you're going to have, like, my parents are they're not going to, their credit file's not going to change. They've been at such a level for such a long time that it would take something drastic for them to fall out of the category they're in. But as you're coming up, it's very easy to ruin a credit score.
Yeah, and let me just focus on that just for a second. So, that's a great point that somebody who's older, like me, and I have a deep and long credit history, if I pay something 30 days late, if I miss it, it might only hurt me 40 or 50 points. But that young person, it could kill them by 100 points or more. And that just comes back to all the other factors: age of credit, mix of credit, how many accounts do they have, your parents. They've been around a while. They've got lots of credit history. All of that credit history supports their credit score.
Well, and it's like anything else, right? I mean, it's like when you meet, you're dating or you whatever, and the person you're now dating or you're meeting has or hiring. That's even better. You look at someone's resume. Your credit score is your payment resume.
Yes.
It's your fiscal responsibility resume. And I say that hesitantly because many great responsible people have bad credit scores. Let me just say, things happen. Okay, things happen that are out of your control. That travesty, tragic circumstances. So please don't take this as if you got bad credit, you're an irresponsible person. That is not the case. I was an irresponsible person.
I was. That's why I
had a bad credit score.
That is why I have a credit repair company. Back when I was young, I was in my 20s. I made all the classic mistakes.
You and me both.
And so I set out to figure it out. And today, I have a credit repair company.
So tell us a little bit about your company and what you do.
Yeah, so my company is actually Financial Renovation Solutions.
Okay, I like that a lot.
We started the company back in 2013. A little bit of background about me. When I was young, like I said, I made all the classic mistakes. I actually wrote a self-published book in 1992 called The Consumer's Guide to Credit Restoration. I never did anything with it. I helped friends and family along the way until we decided to start a business in 2013. We go by FRS Credit. It's a lot easier to say,
Yes,
and that is our website.
FRScredit.com.
Yep.
Okay.
And so when you have low credit scores, and by the way, very common, 87% of people have at least one derogatory mark on their credit report that's impacting their credit
remarkable.
score. And so, when you have low credit scores, people learn to live with it, right? Just like people learn to live an unhealthy lifestyle, or maybe they're doing things, they learn how to do it. And sure, they pay higher interest rates for auto loans and other things. They learn how to operate without credit cards. But when you have a low credit score, you're paying more for everything. And so what happens is people tend to need a reason to fix their credit because they just never get around to it. And so, as I said, you can buy a car with low credit and you may pay 20% interest. I see that on credit reports, but you can't buy a house. So our favorite type of client is the home buyer because they're motivated. They've gotten to that, you have to get to a pain point in your life to decide it's time to address this.
Yeah.
And so a lot of times that's getting married, right? We want to buy a house. And so that's, I would say 95% of our business is referred by mortgage and real estate. And, we love those type of clients because they're motivated, they're going to follow our plan, and we're going to be able to help them achieve their goal.
If you've ever had to have that conversation with a fiance, hey, baby, I got to tell you something.
Oh, I did. And
it'll motivate you, won't it?
I've been married to my wife for 33 years, and that's what started me down this road. We had to have the talk about my credit.
No, that's exactly right. And the thing about it is, there's no magic to fix your credit. It just doesn't work that way. It takes dedication. It takes hard work. It takes commitment. It takes discipline.
And it takes education. And I think I mentioned to you on the phone, 2 things will fix everybody's credit issues. It's time and education. If you let enough time go by, those bad things will age off of your credit report in 7 years. But the problem that I see is when consumers lack the education about how this stuff works, they make these mistakes over and over again, pay something late, whatever that may be. And so they're stuck in perpetual low credit. And we want to change that. So what we do, there's 3 main things we do in our credit repair business. The first is, we're going to leverage those derogatory items off the credit report the best we can. The Fair Credit Reporting Act says that whatever's on your credit report must be accurate, must be verifiable, it must be completely reported, it can't be misleading, and that type of thing. And so we utilize the Fair Credit Reporting Act and then the Fair Debt Collection Practices Act to work the best we can to legally leverage the bad stuff off the credit report. Are we going to get it all removed? Maybe, but probably not. But we're going to get enough of that removed, and then we're going to move into our second thing that we do is we help people build positive credit. So we're going to, recommend, hey, you should apply for this. You may need that. If they don't have any credit cards, we need to have them get one, and we have options.
Card,
we're going to investigate. Is there anybody that can add you as an authorized user? Because that helps. On a credit card, that can help. Get them there as well. So we're going to work to repair the credit. We're going to help them build positive credit. And then the third, which is almost the most important, we're going to educate them along the way so that when they complete our program, they have the knowledge and the tools to keep it strong.
That's so good. That's so good. And is it expensive? Is a big question I'm going to get, right? And I'm not asking you to share your prices, but I mean, for the cost of, Starbucks every day, you can get your credit fixed, I'm assuming.
Absolutely. We have we do not charge a big advance fee. In fact, in the credit repair business, you're not allowed to charge in advance of performing services. So, we follow the letter of the law.
That little juicy tidbit.
Yeah, and so, if somebody's asking you to pay something large up front, you probably should run from that. And so, we charge them an initial consultation, once we've reviewed their credit report. But by the way, let me just mention, we review credit reports for free. So we do free credit analysis for people every day. And you know what? It may be the right time for them to address this through credit repair. It may not be. But they're going to leave our consultation with actionable steps they can do on their own. And then if they're a good candidate for our services and they want to enroll, we do have a small initial fee that we charge them, but then after that it's monthly.
Sure.
And our program's a 6-month program. Not everybody even needs to be in our program for 6 months. So yes, it's very affordable. If you buy a Starbucks every day, you can afford credit repair.
That's the thing, and that was my point in asking that is like, if it's important to you, it's affordable. Because there's things you're doing in your life that you can sacrifice to make this change. If this change is important. And I think that's anything in life, right? I mean, when it all boils down, if there's something in your life that's important to you, you will sacrifice whatever is required to make that happen. If it's time for you to evaluate your credit, you're buying a house, you're getting married, whatever that is, reach out to Sean and his team at frscredit.com. That's frscredit.com. Or you can reach Sean. Sean, what is your phone number?
Our phone number is 214-856-0068.
Awesome. Well, Sean, as always, man, thank you for coming. It's been great.
Hey, I appreciate it. I this is my favorite topic, credit, and I love talking about it. So
Let's do it again soon.
Absolutely.
In the meantime, if you have any other topics or questions you'd like to see us address, drop a comment below. Again, frscredit.com. I am Zach Walker, Director of Business Development for the William Branch Group, and we will talk to you guys very soon.